Every single year, CPAs and CFPs get a certain kind of phone call, and it's from a tech client, someone just like you, who just opened their tax filing and saw a five-figure bill they did not see coming. And the voice on the other end says, "How did this happen?" Here's the most common answer. Their employer withheld 22% on every single RSU vest to cover taxes, but they were sitting in that 35% tax bracket. That gap, in this example, 13 percentage points on hundreds of thousands of dollars of equity, is a spread where no one collected the tax that was actually owed. And trust me, the IRS will collect it, and they'll do it in April with a penalty on top. Hi, I'm Jonathan Nagy with Alpine Road Financial, and in the next 10 minutes, I'm going to show you the exact process I run for every one of my clients every 90 days if anything changes, so that phone call never gets made. So chapter 1 is my promise and the workflow. My promise to you is simple. No April surprises, no IRS penalties, and the tax estimate stays current as your stock price moves up and down. Here's how we're going to do it. 4 steps. We're going to do the same thing every quarter if anything changes. You're going to send me inputs. I'm going to model your year-end and run the numbers through a powerful tax projection software and give you your number to make your payment. That leads us to chapter 2, Withholding 101. Let's talk about the equation. Before we go any further, let me set the stage on what withholdings actually is, because most people I talk to don't think about it this way. Here's the equation that drives the entire tax year. Total taxes due equals withholding plus quarterly estimated payments. Whatever you owe the IRS by April 15th has to come from those two places. If those two numbers add up to what you owe, you're squared away at the IRS. Easy, no problem. But the problem is when they do not. And to complicate it some, here's the part most people do not realize. The IRS, they don't just want you to settle up at the end of the year. They expect you to pay as you earn. That's exactly why your employer withholds from every paycheck. The IRS wants the money flowing in through the year, roughly matched to when you actually earn it. For W-2 wages, your employer handles it. For RSU vests, they typically withhold 22% off the top. For self-employment or side income hustle, nobody's withholding it for you, so the IRS expects you to make the estimated payments yourself. That's what quarterly estimated tax payments are for. You're going to make 4 payments a year: April 15th, June 15th, September 15th, and January 15th. That fill the gap between what your employer withheld and what you actually owe. So now let's talk about chapter 3, which is going to be safe harbor. This is going to be your storm shelter. Now, here's where the IRS gives you a break. They understand things, well, they're going to move around. RSU vests just don't show up on a perfect schedule. Stock prices, they're going to change. They may go up, they may go down. Self-employment income fluctuates too. So, the IRS gives you a concept called safe harbor. And this is going to be a floor that, if you hit it, they will not penalize you. And there are 2 ways to qualify, and you only need to hit one of them. Rule 1, if you're a high earner, pay 110% of last year's total tax. The math is locked in before the year even starts. Rule number 2 is you're going to pay 90% of this year's total tax. That one is going to require you to estimate as you go. You pick whichever works for your situation. Most years, the 110% rule is the simpler one. It just doesn't require you to predict the future, especially when you have a lot of RSUs. But here's where it starts to fall apart. Imagine last year you had a massive liquidation event. Could have been an IPO, a secondary sale, maybe a big tender. Regardless, your tax bill was enormous and atypical. Well, this year, we're back to normal. You're not going to hit 110% of last year's tax. That number, it's simply too big. So the 90% rule kicks in. You only have to cover 90% of this year's actual liability to avoid penalties. That's the flexibility built in. I mean, the IRS knows your income isn't a straight line. So here's how I want you to think about the safe harbor. Imagine you buy a boat and a big storm is coming. You're out in the sea, just floating around, but the surf is starting to get dangerous. So you make the call and you pull into the bay, which is going to be your safe harbor. And you're going to ride out the storm protected by the bay and its natural protection. Now, same idea here. From a tax perspective, April is the storm. If you hit safe harbor, either rule, you're going to be protected from IRS penalties no matter what happens with your income, your equity, or the markets between now and then. That's what we're aiming for every quarter. So chapter 4, let's start talking about logistics. 3 inputs, 3 models, and 1 tax engine. So how do I actually do this for you? Step number 1, 3 documents I need from you. Your most recent pay stub, your year-to-date brokerage statement, and a list of any estimated payments you've already made for the year. That's it. That's everything I need to get started. Now it leads me to step 2. From those 3 documents, I start to build views of your tax year. Your pay stub gives me the year-end wages as I can extrapolate based on what you paid year to date. I look at your base, your bonus, and RSU income all rolled together. The equity tab, well, it's going to track every vest, every sale, and every grant. I'm going to combine those 2 things and create an equity checkboard to start to project your RSU income so that we can run the tax numbers for the entire year. Step 3 then is all that flows into a tax projection engine. I personally use a platform called Plan. CPA or CFP might use something else. The brand, it's just not going to matter. What matters is the engine. It's going to take your wages plus your equity that we projected and run the federal brackets, the state brackets, AMT, give you back your projected total tax for the year. That's the number that tells us what you really owe. Chapter 5. Now, why the rhythm? Now you understand safe harbor and you understand the workflow of projecting taxes. So here's how those 2 ideas come together across the year. For the first 3 quarters, I don't try to predict your final number. I just hit the safe harbor. Let me put some round numbers on it so it's just easier to grasp. Say your safe harbor target is 110% of last year's tax, which equates to $75,000 paid on top of what your employer has already withheld. I split that $75,000 into 3 equal payments, $25,000 in April, $25,000 in June, and $25,000 in September. By September deadline, you've now paid $75,000. You've hit your safe harbor. The IRS cannot penalize you no matter what happens the rest of the year. Then Q4 rolls around and is done. And by January, we have everything we need. Your final wages, every vest that happened, every sale, every dividend for the year. So I can rerun the math with some real numbers. Say your actual liability for the year came in at $95,000 above your employer withholdings. You have already paid in $75,000 towards it. So the Q4 true-up is the difference, which is $20,000. Pay that by January 15th, and you walk into April with nothing owed and 0 penalties. 3 predictable payments to satisfy the safe harbor floor and 1 true-up in Q4 to settle the actual number. Safe harbor is the floor that prevents penalties. The Q4 true-up is the ceiling that prevents overpaying taxes. The case study you're about to see balances out exactly the same way, just with bigger numbers that are real. So chapter 6, meet the Simpsons. Let me make this real for you. Imagine a couple. Let's call them Alex and Sally Simpson. Alex is an engineer at Meta. Sally works at another company. Alex makes about $400,000 base and Sally makes $200,000. Being senior at Meta, Alex also has multiple RSU grants vesting on top of that. They file married filing jointly, and they live now in Washington State, which makes it easier as there's no state income tax. Keep in mind, States like California, Oregon, New York do have state income tax, but it's the same process. So combined gross income with projected RSU equates north of $1 million for 2026. They're going to be solidly in that 37% federal tax bracket. And here is the rub. Meta, his employer, withheld 22% on every single RSU vest for the year. Probably the same thing happens at your company, as the default rate on supplementary income is 22% for the first $1 million. Then it converts to 37% beyond that. So here's the question I have to answer for the Simpsons. What's their estimated tax payment due, and how do we know? Let me show you now how I figured that out inside the master file I use for every household. We are meeting in early April to calculate their Q1 payment due on April 15th for 2027 tax year. This is Alex's most current pay stub. If we look at column E, that's going to be the year-end projection, which I can extrapolate using year-to-date and current payment. Salary is going to be $400,000. And RSU income in this example is going to be north of $600,000, plus a $50,000 bonus paid back in February. Now we go to the bottom, and we see the federal withholding year-to-date, which is $88,700. Year-end projection using this is going to be $192,000. Let's hold that number in your head because it's going to come back in a minute. Same structure for Sally. $200,000 salary. Federal withholdings year-to-date is $16,600. Year-end will be $36,000. If we combine both of them, we have a combined federal withholding for the year about $228,000 withheld by their employers. Now over to the equity side. This is where it gets a bit more nuanced. Alex has 3 grades. The vest calendar shows 987 1/2 shares vesting in the 2026 calendar year. This is how I project income. We now know the value for the February 15 vest, which has already happened, and it was $639.77. But we don't know the future values, so we project that stock price. I'm going to put in $650 to be safe. This is going to be applied for all future vests, and the total RSU income for the year is roughly $640,000 projected. Now we know the rub here is the under withholdings. Alex's employer only withheld 22% on the RSU income, but Alex is in that 37% bracket. So let's go to step 2, which is estimating the total tax using a tax software. Like I mentioned earlier, I personally use a software called Plan. The tool takes wages plus equity, allows me to subtract deductions, and it runs the brackets. So total federal liability projected is right around $375,000. So subtract what's already been withheld by the Simpsons employers and what's been paid in estimated payments to date, which is going to be 0 since this is our first payment due for 2027. That gives me the gap I need to close. So now we switch back to my master file. This is the payment ledger. It is going to spread out the amount due to hit the safe harbor across Q1, Q2, and Q3 estimated payments. Then we treat Q4 as a true-up in January to ensure we have closed the gap. So now Chapter 7 is the result. Here's the audit trail. Year-end tax liability was $375,000. Payroll withholding was $228,000. Q1 through Q3 estimated payments was $65,000, and Q4 true-up was $82,000. Every number on the screen traces back to a specific line in the master file. I am not guessing here. I am not estimating high to be safe. I'm not estimating low and just hoping. I'm using actual math, actual data, and doing it every 90 days if anything changes. So Chapter 8, why does this matter? 2 reasons is the gap in the volatility of stock price. First is the gap. Employers withhold 22% on RSUs like we've discussed. You're sitting in that 32 to 37% tax bracket. For a typical client of mine, it's about $50,000 a year just from that delta. But the gap, it doesn't sit still. Prices change, and let me show you why. This is a tax checkerboard. Each row is one vest event. Past vests are logged in, and we know the date, the share count, and the price. Future vests, well, they're projections, and we know the date and the count, but we're going to have to estimate the price. Imagine we're prepping the Q1 payment back in April, and at that point, only that one vest had actually happened, which is that February 15th vest. The other 3 vests of the year, May, August, November, are still ahead of us. So I project all 3 at the current market price of $650 a share. The model rolls everything up, and total RSU income for the year comes out to roughly $640K. That's the number I built the Q1 estimated payment on. Now fast forward 3 months. We're now sitting in June prepping for the Q2 payment due on June 15th. But now Meta has run. The stock has gone crazy. It's now priced at $800. So I update the price input. Total RSU income for the year jumps from that original $640,000 to $750,000. That's a swing in income. That translates to additional federal taxes we now have to plan for. If I had set the Q1 payment and just walked away and treated this like an annual exercise instead of a quarterly one, that would have shown up as a surprise in April with an IRS penalty on top. That's why I run this loop every 90 days if you were to get any kind of bonus or your stock were to move. And the only way to stay in front of it is to rerun the whole thing every quarter if needed, not once a year. The key benefit is every quarter the estimate gets tighter as we start actualizing prices and the risk of surprise becomes lower. So that's the process. In review, it's 3 documents in and 1 number out. Every quarter I tell my clients not just what they owe, but why they owe it. The IRS, well, they're not going to get aggressive, and my clients don't get surprised. April simply becomes a formality, not an emergency. And if this is the kind of thing keeping you up at night, wondering whether your withholdings is enough, or whether you're going to a 5-figure surprise next April, that's exactly why I built this process to solve. Scan the code or head to alpineroadfinancial.com and book a clarity call. It's going to be 20 minutes, free with no commitments. We'll discuss your equity, your tax situation, and any pain points you have and see where I can help you.